All right. Thank you very much, and welcome to a webinar today. Matt and I, we're joining here from Ben's Financial Office, and we are going to go through a few topics. They basically all related to what's happening in China or what's been happening in China over the last month. I'll first be covering a few sort of macroeconomic indicators and the overall situation in the market, and Matt is then going to go into much more detail in terms of the actual futures market developments, specifically focusing on copper, iron ore, and aluminium. Obviously, if at any point during the presentation you have any questions, feel free to just put them in the chat, and then we'll address them probably towards the end of the meeting if we have some time with a Q&A. With that, I think I'll jump right in. So I'll quickly share my screen here, and then you should be able to see our slides here. All right. Now, to start off, I'll just very briefly introduce BANS. For those who don't know us all that well, we're based in Hong Kong, so that's where Matt and I are calling from today. And we've been around for quite a few years. We're basically a futures broker active on most of the international exchanges, as well as since 2018, when the Chinese exchanges opened up on the Chinese exchanges as well as an overseas intermediary at first. And then since 2021, also as an overseas special brokerage participant of the INE, effectively an overseas participant of the exchange in China. Now, there's a couple of contracts already available for international traders in China. And today we are going to focus especially on the copper contract on the INE. So that's the bonded copper cathode contract here. And we'll also be covering the DCE iron ore contract, as well as very briefly the Shanghai Containerized Freight Index futures contract as well, since that fits really into what we're talking about today in terms of the overall Chinese economic situation and how that connects to the global economic outlook. Now, to start, we actually just yesterday got a very positive update from the IMF. They just concluded their trip to China, and they actually upgraded their growth forecast for this year and next year by 0.4% for both years. So that means they're now expecting 5% growth for this year, in line essentially with the Chinese government figures as well, and then a slowdown to 4.5% next year. This is basically just based on the performance of the Chinese economy so far and the recent policy measures that includes, for example, the latest property rescue plan, as well as the consumption stimulus, for example. Over the long term, they still see growth decelerating towards the end of the decade, so hitting 3.3% by 2029. In terms of core inflation, very little in terms of surprises here. They're expecting that to stay low, basically where it's been for a long time now, with no major changes to the upside or downside. However, they do generally see more risks on the downside, especially when it comes to the property sector, just because this is still something that's very much in progress, as we'll see later on in the presentation. It's very much ongoing, and depending on how things turn out, if anything goes sort of not to plan, they see it more likely or not developing more negatively than one would expect. They also mentioned specifically that essentially the ongoing correction is necessary. It's really important for this to be completed, for the Chinese economy to essentially move on from this point and move into a more sustainable stage where the focus is away from a lot of real estate and more towards sort of healthier overall economic growth and development target. They specifically mentioned in terms of social safety nets, for example, and supply side policies. They really see the role of the government there as providing additional support for people to essentially make sure that they can focus on spending their income as opposed to saving it for a rainy day. and at the same time fighting the overcapacity that I think we've all been hearing quite a lot about in the media in recent weeks. Now, coming to our first slide here on the Chinese economy, specifically the housing sector. Xi Jinping famously said that houses are for living in, not for speculating. And even though we just heard a couple of weeks ago that China announced its new policy providing 1 trillion RMB of essentially additional funding to support the housing sector, this is not something that is going to fundamentally change the direction of the property sector. This is not something, a so-called bazooka, that is going to suddenly turn everything around, because the purpose here is very much not to create a new boom. It is just to essentially ensure stability and make sure that stalled projects actually get completed. And as part of that, some of the funding in terms of loans is actually going to be for local governments to essentially repurchase land, for example, from developers or even housing projects and complete those, and ideally then turn those into affordable housing, for example. This is something, how that actually is going to turn out is going to be a bit more challenging, certainly in sort of richer governments like Shenzhen or Shanghai. We can definitely see that support already. We can see Shenzhen basically lowered the down payment requirements, etc. Shenzhen recently purchased a plot of land from China Vanke after the developer actually had issues with their sort of short-term liquidity. But these are fundamentally two of the richest cities in China. So whether the other more indebted local governments can actually cover those shortfalls, even with additional loans from the central government, from the PBOC, is questionable. So it's going to be something to sort of keep track of to see how that actually turns out. And ultimately, while all of these policies may increase turnover, it's unlikely that we'll see prices rising, at least sort of in the short and medium term, just because at this point there still are unrealized losses in the market. So as essentially the measures in the housing market are relaxed, we're going to see more transactions, and all those unrealized losses are then translated into actual transactions. So that means we're likely to see more losses showing up in statistics that just we haven't seen so far. Looking at the impact this is having, we can see on the very sort of lower right end of the top chart here, there's a small positive movement in the CSI 300 real estate index. In the grand scheme of things, it's still not a huge change. It's still quite a bit down from its peak just around 2020. But I suppose it is a positive sign to finally see a bit of a rise here. The question is whether this is going to be sustained. Again, on the one hand, we're certainly seeing more support for the developers that are still, alive, essentially, after the last few years. But it isn't that bazooka that is just going to save them and make all the issues go away. There are still fundamental issues. We can also see, if we look at, for example, the output in the Chinese economy of basically construction equipment, so as excavators, earth-moving equipment, we have been seeing the year-on-year figures. They just climbed above the zero level here. So we are seeing very minimal growth based on the very latest data point. But if we're looking at the cumulative chart here as well, long term, it's still in negative territory. So there is no big change when it comes to property investment. In fact, if we go to the next slide here, we can actually see that the floor space that is under construction is continuing to drop. So we had a sort of peak here just around 2021. And this is ultimately when the policy crackdown on all those developers came into force. And since then, we've really seen that floor space fall. We had a very brief pickup in early 2023 after the COVID-0 policy was abandoned. But since then, it's really just continued its downward trend, maybe slightly flatter rate than we've seen previously. But again, there's no turnaround here. It may have bottomed out just around sort of March, but yeah, whether this is actually a trend that is going to continue, we'll need to see, and we'll need to track further. We can actually also see that at this point, completions are outpacing new starts. So actually the only figure at this point that is above zero in terms of year-on-year growth is actually property completions, and even that has now dropped back below zero. And that is just because you have policy support to get the projects that are underway done, to let people move in, because a lot of these people, they already pay their down payments, they've already been paying their mortgage. So obviously the government wants to make sure that they can ultimately receive those flats they bought and move into them. But yeah, in terms of new starts, there's little positive news that we can see here. It's still falling and continuing to fall. And if anything, the trend is now accelerating again. If we look at the property investment chart, we can see sort of the light blue trend line in the background. This is obviously very cyclical, but again, we can see here around 2021, this is when property investment peaked. And since then, it's been on this very steady sort of downward trend. Again, we can compare this also to the planned investment, the yellow line here, which also peaked actually already in 2019 in terms of its growth rate. So we're still growing until roughly early April 2022. But since then, it's been continually negative and slowing down further and further. So that means in the future, we're not likely to see any turnaround here, just because the real estate and property investment sector is now in a very different phase than it was even just 3 or 4 years ago. And these trends are now changing quite consistently. One actually quite interesting data point that we can see here, that is perhaps also reflected in the service sector and manufacturing sector PMIs, is when it comes to office investment, we're actually seeing that just spike back up year on year above zero. So actually it's picking up a bit, while investment for business use, the dark green line here, is actually continuing a much steeper downturn. So that means service sector offices are doing, or seem to be doing, slightly better, at least if we sort of believe the property investment figures, whereas it seems retail shops, etc., are struggling much more than the service sector in China. And lastly, we can see land acquisitions. Similarly, they actually had a significant peak here in 2018 already, and since then they've been on a steady downward trend, just because essentially the pace of development there, the locations oftentimes just were not sustainable. So this is all something that is essentially, well, in a place where the chickens are coming home to roost, essentially. So there was overinvestment, and now essentially the governments are getting support from the PBOC to repurchase a lot of that land that was sold to developers or local government financing vehicles. And yeah, essentially nothing happened with that, or if anything, there maybe developments were started but never actually completed. Next, just very quickly looking at unemployment, we can see there's a bit of a gap here. That is when it turns out the youth unemployment rate was a bit too high for their liking in Beijing, it seems. And they briefly suspended that. They replaced it with actually a few different figures since then. But the most important thing that we can see here is that if we look at the urban unemployment for people 30 to 59, this is the lowest rate here. And the younger we go, 25 to 29, and then 16 to 24, the higher the unemployment rate. So even though, you know, technically it looks like this has come down a bit, we can still see that unemployment is much worse the younger you are. So that means for young graduates, for example, it still seems to be very tough to find a job. And all these lines here are very flat, going up if anything. So that means there just isn't any significant improvement. The other thing that we can see is we have average weekly working hours, and they've also dropped quite a bit since the beginning of the year. And this essentially reflects a push likely by companies to cut overtime, which usually costs them more. since you have regulations in China whereby if you're requiring people to work overtime, you're going to have to pay them more. So it's ultimately cheaper to actually just have more people employed and keep them working regular hours. So that means, while the unemployment rate overall may be flat, this could reflect simply a trend whereby companies are hiring more people to ultimately have them on average work less per person for the same output, and obviously then paying them less, which isn't great for incomes. Now, the next series we have here is CPI and retail sales. And when it comes to CPI, there, as I mentioned, really isn't anything exciting here. We can see it is very much dominated by food and tobacco, transportation, and communication. Transportation obviously is one of those sectors where we've seen a lot of overcapacity in the industry. Food and tobacco is, well, not something that is going to give you a very good indication of where the economy is moving, just because the prices fluctuate fundamentally a lot. And those really dominate where the CPI is moving. All the other sectors are actually in positive territory, even between 2 and 4%. So I would say CPI isn't something to worry about in this case. We have other sectors of the economy, other charts that we can look at that I think are a bit more telling when it comes to the issues China may be facing. And apart from that, similar to retail sales, we've also seen that figures are rising, but the growth trend is slowing down. So yeah, we had a sort of very strong start into the year, but the question is whether China can sustain that trend. Now, next, if we look at the exchange rate, RMB to USD and Japanese yen, the thing here is that the Chinese yuan has weakened a lot against the US dollar here in blue. Basically, since 2022, we can see it's obviously gone up quite a bit here. The thing is, the PBOC is very much caught between a rock and a hard place here, because the Japanese yen has weakened even more against the US dollar, which has obviously made Japanese exports more competitive on the international market. And the Chinese yuan is usually managed, sort of against a basket of currency, not just against the US dollar. So that means just looking at the US dollar rate isn't going to tell us anything about where the PBOC wants to see the RMB move. We need to look at more rates, and the Japanese yen here is significant. We can see the RMB has actually strengthened quite a bit against the Japanese yen. So that means, yeah, there's not much the PBOC can do if it wants to stay competitive on the one hand against the Japanese exporters, and on the one hand, not make imports get priced in US dollars too expensive. Now, the next episode that we can move to is, well, the return of the tariffs. I think that's been something that has certainly dominated news reporting, I would say, over the last couple of weeks, if not months. And just recently, we've seen the latest Section 301 tariffs instated by the US, covering a range of ostensibly Chinese imports, especially when it comes to things like solar panels, batteries, electric vehicles, gantry, basically those gantry cranes in ports to offload containers. All these things have basically, the tariffs here have gone up quite a bit, from 25% to over 100% now for EVs, for example. And well, the idea here is that, ostensibly in the US, they want to fight this Chinese overcapacity that I've been talking about quite a bit. They're worried about, well, as I like to say, cheap Chinese imports flooding the market, driving out their domestic producers. And if we just look at auto exports from China, we can see this has gone up quite a bit. So perhaps there is something to be worried about. But one thing we need to consider is that, well, the timing here, since when they've gone up. Because right at this time, just around February 2022, a certain somebody appears to have misread his map of where his country ends and a different country starts. And we've actually seen car exports from China rise significantly since then. What happened is European car manufacturers were driven out of Russia. Chinese car manufacturers came in, replaced those. And so actually Russia at this point is now the largest import market for Chinese cars. So all this overcapacity for now does not seem to be going to the US. I think estimates for Chinese-made cars in the US range from between 50 and 100,000 in total among the tens of millions of vehicles in the US. So this is not annual imports. This is the total amount of Chinese cars in the US at this point in time. So the threat here is still quite limited. And obviously with the 100% tariff, there's little to be worried about for US manufacturers. For US consumers, well, perhaps more, but that's not something that the Chinese manufacturers can change, at least as long as they stay in China. However, it looks like a lot of them are now moving into Mexico, for example, setting up manufacturing there. Brazil as well, very attractive targets. So we're seeing perhaps a shift towards more exports into the global south from China to diversify away from the Western markets, and also even setting up production facilities in those countries, especially if they have free trade agreements with, for example, the EU or US. The next thing to look at when it comes to all these trade wars is the effect this actually has very short term, because all these car exports is a very long-term issue. In the short term, the one thing that we can look at is how this actually affects freight rates, because all of the uncertainty about where tariffs are going to move, especially with the election in the US coming up, nobody knows whether Trump or Biden is going to be back in office. And I think both of them have not been very keen to let in more Chinese imports. So a lot of importers in the US, for example, may be very keen on actually front-loading their imports, adding further strain to the already very limited capacity, because all these ships are going around the Cape of Good Hope since they can't traverse the Suez Canal. So that means this has really been soaking up a lot of capacity in the container sector, and that's driven up prices significantly. In fact, we can see just this week a lot of sort of worries about port congestion happening this time in Singapore, the second largest port in the world, actually developing. And if you look at the statistics here, we now see global port congestion at 2 million 20-foot equivalent units, so that's 20-foot containers, which is basically almost 7% of the global container market or the global container capacity. And the delays in Singapore, essentially ships trying to berth, unload and load new containers, is now up to 7 days, which alone in this single port is soaking up 450,000 sort of units of capacity just there. And this is still something that looks to be growing, and is causing a major headache for anybody who is basically in the Asia to Europe business, because Singapore is a key sort of transshipment point as well, where containers get offloaded and unloaded onto new ships, and any delays there are causing havoc for supply chains. Fleet capacity overall was actually expected to rise 9% this year, but we can see, based on the weekly capacity rates published by industry publications, the actual capacity is down 5%. So that's a divergence of 14%, which is huge when you compare it to the fact that in recessions or expansions, the actual capacity usage only differs by about 5%. And this is obviously reflected in freight prices. If we look at the INE-EC contract, back when it was launched in August, it was at just 1,000 index points, and it has now reached almost 4,500. In fact, even looking at just the recent developments since March, it's gone up from 2,000 to 4,500. Now, because this is obviously a new contract, a new industry, we are actually hosting a trading competition as well. So anybody interested in trying out that contract, it's a complimentary trading competition, basically trading on a simulated INE, and try that contract out. You're welcome to sign up as well. And yeah, with that, I'm now going to hand over to Matt, and he is going to go into a bit more detail the rest of the futures market in China.
Thank you. Thank you, Vincent. Yes, and I'll start. Hello, everyone. My name is Matt, and today's topic will mainly focus on copper, iron ore, and aluminum, and also talk a bit about our findings for the copper's markets in May. And I'll start with bonded copper. So, as Vincent just introduced previously, one of the internationalized contracts bonded copper, which is a Chinese copper that is tax-free. So you don't need to pay any import tax when you deliver into the exchanges. And so briefly, this contract is being traded in INE. And the next slide is gonna talk about how we calculate the BC-CS spread, which means the INE-BC copper premium over LME copper. So basically, we transfer the bonded copper's price from CNH using SGX-UC, which is the renminbi contracts converted to USD, and minus the equivalent months of LME by considering the spread between the month and the 3M prices, and deducted by some miscellaneous cost. So we'll get the BC-CS spread. So it means a BC premium or discount over LME-CA. And you can see the formula down below. So this chart shows the recent development of the spread between INE bonded copper and LME copper. And we can see actually the spread is quite fluctuated between positive 50 to negative 50s. And during the May, it has been traded in the negative territory for quite some time. And we conclude a few reasons why the BC-CS spread is being negative in May, since we have been monitoring this spread for about 2-3 years since it's launched, and we seldom see the BC-CS spread went into a negative territory, except for this year. And there's a couple of reasons. The first one would be the weak downstream demand in China. There's evidence that the high stock levels post CNY, post Chinese New Year. We will see that chart in the later slide. And the second reason will be copper is not micro-driven this year, with more like macro-driven. So it means that it's more fund clients and more non-trading house or non-spot non-spot market participant is joining this market. So especially we see in the middle of May when the copper squeeze, when the COMEX happened, a copper squeeze, and so we can see the spread, especially for BC-CS spread, it went down to negative 50 USD per ton during from 12th of May to like 18th of May. And we have checked with several trading houses or spot traders. Their feedback is that basically, if we want to transport the copper from China to the nearest LME warehouse, no matter it's in Korea, in Kaohsiung, or in Singapore, the cost will be for around 30 to 40. So it means that when the BC-CS spread is trading at negative 50, actually we have risk-free opportunity for you to trade this contract, and afterwards you transport the copper from the bonded zone of Shanghai to nearest either Korea, Kaohsiung port. You can earn the differences in between. And thirdly will be the consistently negative copper import arbitrage, which means that there's not much buying interest from the Chinese spot traders or trading houses, especially when we can see the correlation between the absolute price of copper and also the BC-CS spread. Recently is showing an adverse movement. So when copper is going up, the BC-CS spread going down, which means the buying interest of China is still going down. So we can see the bonding premium, which evaluated by SNN, it went from around 40 in the beginning of April down to negative 20, which means there's not much buying interest from China. And the next slide, especially we look at the bottom chart, it shows how market sentiments of of the market participants in China. So in March, we see the structure, the Shelby copper structure is more or less level. So, and when the time goes by, April, May, we can see during the May, especially when the copper surged to historical high of above 11,000, we see the structure of Shelby copper went down to 700 contango for the M1 and M4 spread. So, and if we see the next slide, for the bottom chart, we see it is how you compare the spot copper price with the first continuous month of Shelby, and it went down to 300 contango. It means that price goes up, no one want to buy the copper. The spot demand goes down, everyone to stay for a while to see if price will go down. And evidently, recently when the price goes down, it goes down from the recent high. We see a lot more and more interest of spot traders in China or trading houses in China have more interest to buy copper. And if we look deeper to the Shelby, the price compared with Shelby and LME, we see the Shelby price did go down relative lower, smaller than the LME. And for the upper chart, it is how you compare the stock accumulations compared to the pre-Chinese New Year's 4 weeks average. So the black line is the situation of this year and compared with the 10 years data, and we see the stock accumulation, especially for this year, is quite massive compared with past 10 years. And also, if we look into the data here, normally after week 7, after Chinese New Year, the copper stock was started to draw down, but this year obviously is different. Instead of drawing down, it just maintained at a level relative high compared with the 10 years average. And so that's why normally Chinese is an importer of copper. This year, they started to export their coppers out even to US, which never seen for 20 years after the copper squeeze happened in the mid-May, or they just maintain the copper in the bonding zone. So that's why there's another perspective to see why the bonding zone copper stock level is being increased from 20,000 to 70,000 recently. And there's another interesting findings that we have found recently is that since we're keen to comparing the copper price between different exchanges, Shelby, INE, LME, COMEX. So in here, we are comparing the Shelby LME and Shelby COMEX copper ARB. So after the Labor Day holiday on this May, on May 6th, the first trading day after the holiday, we see the LME was closed for that day for bank holiday, so leaving only COMEX and Shelby's copper being traded. And on that day, since Shelby's copper, Shelby just opened for trading, and he's trying to catch up with the holiday gain for COMEX and for Shelby. But as we can see from the chart here, it seems a little bit overdone for the price increments compared with COMEX. So that's why we see the spread between COMEX and Shelby. It went up significantly from approximately 1,200. So it means it up loss from 2,000 renminbi per ton to only 600 renminbi per ton. And if we are for every veteran spot trader, they would know this 600 this 600 renminbi per ton means, since at that time COMEX copper is $100 above LME coppers. So if we convert this 600 back to the LME prices, it means that now it's in the import profits break-even point. And it is quite bizarre or quite weird this year, since most of the time this year, the spread is being traded at negatively. So if it suddenly goes up to a break-even point, for every spot trader, they would just dive in and trade, no matter close their export arbitrage positions or open as many as import arbitrage position they want. But in real term, it's not the case for COMEX copper and Chevy coppers. And you need to wait until the next day, LME exchange opened. So we see the Chinese or the Chinese trading houses start to act in or started to trade the arb between LME and Chevy. And also, so we can see from the table below, in just 10 seconds, the arbitrage loss correctly from being corrected from 400 loss, 400 RMB per ton loss to 800 RMB per ton. And with next 10 minutes, it corrected for additionally 300 RMB per tons. So it means that from this case, we see the loose connection between COMEX copper and Chevy copper, but Chevy copper and LME copper have a strong correlations and connection, as well as LME and COMEX. So it's like a triangular relationship, even though the Chevy COMEX did not has a strong connection, but the other two will make that corrected after the other two exchanges being open for trading. And the next is I'm gonna talk about iron ore spread, we compare the price between DCE and SGX, and as well we use SGX UC to convert the DCE price from CNH to USD, and including some tax. And for this year, for the year beginning, we see the DCE iron ore is performing much stronger than SGX iron ore. Especially when the year begins, a lot of people are expecting that the Chinese government gonna introduce more stimulations or policies to rescue the, especially for the property sectors. But however, when times goes by until February, March, April, the market didn't see any clear sign of the government is releasing more persuasive policy to support the property sectors, which is the main drivers for the iron ore. So we see the DC iron ore started to drop relatively compared to SGX iron ore. And last but not the least, of the aluminum brief in China recently. So for the left upper chart, we see how the market sentiment changes between March and May. For March, aluminum demand is not looking good, so we have a contango there. But for April, May, it dropped back to level. And if we compare if we see the stock level for aluminum ingot and aluminum billet, actually we see some sign of stock draw depreciations after April, after March this year. Probably it is one sign that the aluminum demand is being better off. And actually, when we from our conversation with our connections in China, actually the demand is not bad this year compared with, if we compare with copper, and also aluminum is the most the best during the other base metals. And just yesterday, we see the Chinese government release their action plan for energy conservation and carbon reduction. And what we see from here is that the plan indicates that they're gonna increase the proportion of recycled aluminum usage to 24%, and also the consumption of liquefied aluminum directly transferred to aluminum alloy. They want to increase this number to 90% by 2025. And the number for this number for this year is around 70%. So there's another 20% to go. And I think I will stop here.